A chart like this is probably why most of us invest, myself included. That long, beautiful upward line of historical stock market performance gives us confidence that over the long term, markets will go up. We've all heard that past performance is no guarantee of future returns. But what if past performance isn't even a guarantee of past returns? Let's start with this chart. It was compiled by someone who works at Google and NASA, so it looks credible. But let's add a few key dates. In March 1957, Standard & Poor's expanded its index from 233 to 500 stocks, what we now know as the S&P 500. This chart goes all the way back to 1871, yet you couldn't even invest in that index until 1976, when the first index fund was launched. That's 100 years of data before it was possible to actually buy the thing. For global investors, MSCI launched its World Index in 1986. But buried deep in its documentation is a small disclaimer: the data may contain backtested performance. In other words, much of what we think of as historical returns is hypothetical, reconstructed after the fact. There are frequently material differences between backtested and actual performance. So even the data we take as fact is, at best, an educated estimate. The gold standard of stock market history is the work of Dimson, Marsh and Staunton, who compiled 125 years of global returns across 5 asset classes. Their research is exceptional, but as Dimson himself once said, the standard data available before they started was very misleading. That's a strong word, misleading, and it highlights a big issue: survivorship bias. Survivorship bias happens when you only study the winners. There's a famous example from the 1980s. Researchers studying cats that fell from buildings found that cats falling from higher floors had fewer injuries than those from lower floors. The conclusion was that cats falling farther had more time to react, until someone pointed out the flaw. Dead cats don't go to the vet. The data only included the survivors. Stock market data has the same problem. Before the 1930s, companies didn't have to report bankruptcies or mergers. Many simply vanished. Their records were lost, leaving only the winners behind. Dimson and his team tried to account for this by including failed markets, like Russia in 1917, and digging through old archives for lost companies. But we'll never know what we don't know: how much data was lost, misreported, or never recorded in the first place. And even when records exist, how trustworthy are they? Early stock prices were shouted across trading floors and written on chalkboards. Information was sent via telegraph and ticker tape. Wars, inflation, and economic collapse didn't exactly make accurate record, keeping a priority. Some of what survives might even be fraudulent. Just because something was written 100 years ago doesn't make it true. Dimson and his colleagues go to great lengths to correct for bias, but their work relies on a chain of trust, previous researchers' data. For example, much of the pre-1900 data comes from Alfred Cowles, who focused on railroads and based his own work on research by Frederick Macaulay. Later studies found errors and omissions in Cowles' data, entire railroads left out, inconsistent decisions about which companies to include. The result? Market returns for the 19th century were overstated. Stocks didn't actually outperform bonds back then. This isn't to criticize Cowles or any academic, really. Science evolves. We once thought ulcers were caused by stress until a scientist drank bacteria to prove otherwise and won a Nobel Prize. The point is, our understanding changes over time, even in finance. We constantly revise, refine, and rewrite the rules. Take the triumph of the optimists, Dimson, Marsh, and Staunton's landmark book, published in 2002. It originally covered 101 years of returns across 16 markets. Today, that dataset spans 125 years and 33 markets. Impressive, but also revealing. What counts as the global market has changed. Before the 1970s, we barely had detailed stock data outside the U.S. Many so-called global studies really just meant the U.S., UK, and Japan. There are over 60 major stock markets today, but much of their data only exists from the 1980s onward. Even how we classify companies has evolved. The system for defining sectors, what counts as tech versus industrial, for example, wasn't standardized until 1999. So when we look at old data, we're comparing markets that played by completely different rules. Indexes themselves have changed too. The S&P and MSCI eventually adopted free float weighting, which excludes shares held by insiders. That's like changing the rules of the game while we're still playing it. Looking back, no wonder the numbers don't line up neatly. And at some point the comparison becomes almost meaningless. In 1870, horses were the fastest way to travel, unless you hopped on a steam train. Today, a Boeing 747 has over 100 horsepower. Comparing the two is absurd. In the same way, comparing 19th century markets dominated by railroads to today's tech-driven economy is like comparing horses to jet engines. Entire sectors, industries, and even countries have shifted. Japan dominated in the 1980s. Now it's shrunk. China barely appeared in the data before 2000. The market has transformed. That's why the idea that you could have invested £100 in the S&P 500 back in the 1800s is more fantasy than reality. Regular people weren't buying diversified stock portfolios. Markets were exclusive, opaque, and often corrupt. The structure of investing itself, index funds, public reporting, regulation, simply didn't exist. So how useful is any of this for predicting future returns? I'll admit this research humbled me. I've often quoted that the global stock market has returned about 9% per year before inflation, or 5% after, for over a century. But much of that is based on reconstructed, backtested, or hypothetical data. If you want solid, reliable numbers, the 1990s onward is where the real data starts for global markets. Still, Dimson, Marsh, and Staunton consistently show that markets have rewarded investors over time. That doesn't change my investment approach, but it does make me more cautious about using historical averages too confidently. The U.S. market has outperformed others by about 2–3% per year since 1900. But is that genuine superiority or just survivorship bias? We know it's the winner now, so we look backward through that lens. A century ago, nobody knew which market would win. If you could go back to 1900, would you bet everything on one country, or diversify across all of them? The diversified investor might not have made the most money, but they would have avoided catastrophic losses. And that's really the lesson here. Investing isn't about guessing the next winner. It's about reaching your goals while minimizing the chance of ruin. So next time you're using a compound interest calculator to project your future wealth, don't just plug in the average return of the last 100 years. Stress test your plan across a range of returns, optimistic, moderate, and low. Because the further back we look, the less certain those numbers become. The past may guide us, but it's far from guaranteed.